Hi, welcome to Bond Bytes, the daily bond market highlights from INR bonds. I'm Arjun Patsati. And just the one day before the RBI policy review meeting, which is going on, and tomorrow the RBI will come and talk to the press and give out their policy, give out what they have decided, finalized in the policy. It's called the MPC Monetary Policy Committee. Bond markets were slightly more in anticipation of RBI coming and soothing the nerves. And they have bond yields, GSEC yields have fallen from to 6.82%, 10-year GSEC yields. It had gone up to over 6.9%, closer to 6.95% just after the budget last week. And the equity markets too have saw some positive trends, while the rupee was also marginally positive. And in the global treasury market, US 10-year yields continue to scale higher to 1.96% on worries of wage inflation, and Fed rate hikes faster than expected and sooner than expected. And also Bharti, in the corporate bond side, Bharti Airtel is preparing for 5G auctions and its related infrastructure capex requirements, and they've approved a rupees 75 billion or 7,500 crore rupees fundraising program for the next financial year. And you should see more and more telecom companies coming to the market to borrow for the 5G auctions. However, there are only two telecom companies that are still reasonably in good shape, while Vodafone debt is clearly making the company finding it very difficult to raise funds through the debt route. And so just a preview on the RBI policy, but before we go into that, don't forget our 8 o'clock session, evening session on Twitter Spaces, where I'll be talking about the change in interest rate cycle and where should fixed income investors invest their money, given given the issues facing the debt markets at this point of time. And also, do not forget to download our Quick Invest by INR apps, where you can find the best bonds, short-term 1 to 2 year maturity bonds at very attractive yields with moderate risk for you to invest to tide over this current rising interest rate scenario and very sharp rise in yields that is affecting all your other portfolios in the fixed income space. And you can earn much more than what you can earn in FDs. All you need to do is download the app, check the information, and it will take you straight to the investment, and you get your bonds into your demat account as soon as you transact. Coming to RBI policy, we have RBI coming tomorrow. What are they going to say? Clearly, if they sound too over optimistic, which they have been sounding on inflation and many other things, then I think the markets they cannot fool the markets. Clearly, they have to take a right note. They have to be cognizant of the fact that inflation globally is very high. The US Fed is also acting very sharply, as is Bank of England, and ECB is also removing policy accommodation. And all this is clearly showing up in the fact that very tight labor markets are creating a huge wage growth pressure. And this is filtering down to India as well. And India is also seeing high inflation. Core inflation is at 6% levels and staying above 6% for a longish period of time. And the RBI cannot really punish savers. And with the government now clearly adopting a borrow and spend policy for economic growth, then if the RBI continues to support the borrow and spend policy, which is fine, which is because if the government has to borrow, RBI has to manage the borrowing. But if they continue to suppress yields, the spending can result in higher inflation. And if the spending results in higher inflation, then the consequences for the savers are pretty high. So all this will have to weigh into RBI's minds. And the question is that, look, given that the Fed is likely to hike rates in March, and given that the government is coming out with a very heavy borrowing next year, and RBI may have to start buying bonds as well, then just to guide the markets, will they raise, will they give a nominal rate hike of 25 basis points to the repo rate? They brought the repo rate down to 4%, the benchmark policy rate, to record lows of 4% just post the COVID to spur economic growth. But now, with inflation and many other factors pointing to a much more difficult period ahead, and with asset price bubbles and equity markets at record highs, and RBI does mentioning in their financial stability report that there could be rational exuberance. Is it a time to start worrying about, to start tempering markets inflation expectations by hiking rates? We will know tomorrow, but in the meanwhile, bond markets have been positive going to the policy, but this may not continue if the bond market is disappointed with RBI policy tomorrow. Thank you for listening in. Do not forget to download our Quick Invest by INR Bonds app. The link to the downloads are given in the description below. And do attend our 8 p.m. session tomorrow on interest rates, cycles, and where to invest money on Twitter Spaces. Thank you very much. And uh, press the like button and do not forget to subscribe to our YouTube channel if you're not done so already.